the issue that the central banks have got is that they have been caught so far behind the curve on their inflation calls. We've seen that all over the developed world, not in China and parts of Asia, of course, where it's a different story. And so I think anything is possible. I mean, the inflation print the day before yesterday in the US is perhaps case in point. We've got another meeting next week. The chances are we'll see another 75 basis point there. But the market, about a third of probability is that it will be higher than that, and that 100, as I'm sure you're aware. And so we're seeing 75 in Europe. And so, yeah, in the UK, I think anything is possible. Although in the UK, I think they tend to be a bit more staid, a bit more measured. I think a 75 basis point rate rise in the UK is unlikely.
Simon, if I can just bring up the trading patterns, then we've had this slightly odd, volatile trading day for one day where the market's just sold off aggressively, and now we've settled down into sort of this boring pattern on the back of it. What's going on? Do you think the volatility is indicative that investors just still don't know which way to jump at this point?
I do. I think we're only back to where we were a week ago in the US. If you look at the S&P, for example, which had its biggest down day, as we all know, on Tuesday, 4% or so, and 5% on the NASDAQ. I think it was an outsized move. I think it gives back some of that summer rally, but I think what it reminds us is that the markets are still pretty flighty and still quite uncertain in terms of where we're going to go. Central bank policy on rates, might it be higher than people anticipate? And I think that is what scares the market. On volatility per se, Vol still has been stuck at around the 25, 6, 7 level and hasn't actually spiked much. You would expect it perhaps to have spiked more than 30, which it's not done. And so, yeah, I think it was an outsized move, and we seem to be now back into a bit more sanguine. The European markets were off a bit, but not a lot yesterday. The US market is showing up a bit in the futures. So, yeah, I think it's caught a lot of people by surprise. And in terms of the direction of inflation, let's just remember that the inflation print was higher than the market was going for. But let's also remember that it's coming down. So there's a good chance that the inflation peaks have been set in. It was 9.1, 8.5, I think, and then now 8.3. The trend is down. And if you look at the indications in the market, you'll see that those trends for longer term inflation, such as the 10-year break-evens, are also coming down a bit.
Yeah, Simon, as I look around the markets then for value or opportunity, obviously your eyes fall upon emerging market ETFs and other emerging market space investments. But I'm sort of very aware that the jury is still out in terms of, 1, inflation, 2, where monetary policy is going, and 3, what global growth is going to look like going forward. Are we anywhere close to an entry point for emerging market assets?
We don't think so. Our exposure to emerging market is broadly in line. That means China in particular, which is a third of emerging markets, is in the region of 4 or 5%. China, I think, is suffering currently from 2 key issues. One is that its zero policy on COVID is easing, but it's having a material impact on domestic growth. And 2, the property market, which you were talking about earlier in China, I think is also, given it's such a big contributor to growth in China, is also under pressure. And that doesn't seem to be easing. So we're not looking to increase exposure to emerging market yet. And if we were looking to, and where we are looking to, we're looking to do it really in the developed markets more so, and more in the value space, so European value.
Yeah, which is fascinating because obviously we started with a conversation about a single stock, Shell, and you talked about how you're currently looking at opportunities to maybe sell down a little of what you own. What are you looking to accumulate then on a single stock basis?
So we have recently been buying Glaxo, actually, which has come down aggressively since the stock split a month or 2 ago on the back of the legal issues. Our analysis suggests that most of the bad news, if not more than all of it, in fact, is discounted in the Glaxo price, which has fallen from 16 to around 13 pounds, a little higher, 13.50 maybe. And we're looking to take advantage of that. It's a defensive. We like healthcare. It's reasonable yielding. It's got some sensible growth coming through. We think it's not the world's most exciting play, but we think it's a good long-term, steady defensive play.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.